You may have heard by now that the Fed decided to raise the Fed funds rate by another 0.75% yesterday. So far, year to date, the Fed funds rate has increased 3%. If you've watched my Summer 22 Mortgage Matters, you know that the Fed does not raise mortgage rates. These Fed fund rates hikes do, however, have a direct impact on consumer debt, like your credit cards, your home equity lines, and car loans. Times are tough, and they're getting tougher. We saw the largest increase in household debt ever in second quarter of 2022. And my biggest concern is the growing balances in interest rates on credit cards. Credit card interest not only adjusts monthly, their rates tend to be higher than other types of consumer debt. So every time you hear the Fed has raised interest rates, you can expect an increase in the interest rate on your credit card. The average credit card interest rate is between 16 and 18%. However, if you have less than stellar credit, or you're like me and you like to use credit cards with perks such as earning air miles and free hotel stays, our credit cards typically charge an even higher interest rate. You're looking at between 20% to 25%. And if you pay it off every month, no big deal because they're not charged interest. However, if you carry a balance, these increases are going to impact you in a very big way. And I want to make sure you're aware of them so that you can do something about it now. So review your credit card statement the next time it comes out. What interest rate are you being charged? Are you able to pay off the entire balance each month? Are there ways you can tweak your spending so that you aren't heaping more debt on top of what you already owe? What can you do to start paying down the balance more aggressively? Because folks, these rate increases are not easing up anytime soon, and it's only going to get harder. And if it gets to a point where you're struggling to even pay your minimum payment or you're paying slow, your credit is going to suffer, and then your interest rates are going to go even higher, and it is just a vicious cycle. So I want to try to help you now before it gets there. If you have to carry a balance, can you transfer that to a lower interest rate? Look into other credit cards or maybe look into an equity line, or maybe look at refinancing your mortgage. Sure, you may have a very low rate on your current mortgage, and refinancing and paying off those credit card bills may mean moving into a higher interest rate on your mortgage. But if you look at the overall picture, you may find that you're still saving hundreds, maybe even thousands, just depending again on your particular situation. If you have any questions and you would like one of our mortgage professionals to take a look at your financial situations, we're happy to do that. We do not charge to do that. We're here to help you and answer any questions you may have during these difficult times, and all times actually. So my name's Leslie Swart, one of the owners of Blue Skye Lending.